When talking about finances, there are a lot of things to consider other than just keeping your money in your bank account. For example, your money needs to grow and further expand its value. But how are you going to do that? For today's episode, we are going to talk about the top 10 things you should invest your money on. But before anything else, don't forget to hit that like, share, and notification bell to keep you posted on more videos like this one. Welcome to Fortune Figures. Without further ado, let's get started. Number 10. Value stocks. A value stock is a security trading at a lower price than what the company's performance may otherwise indicate. Investors in value stocks attempt to capitalize on inefficiencies in the market since the price of the underlying equity may not match the company's performance. The most common way to value a stock is to compute the company's price-to-earnings ratio. That is, P/E ratio equals the company's stock price divided by its most recently reported earnings per share, or EPS. A low P/E ratio implies that an investor buying the stock is receiving an attractive amount of value. That's why they straightforwardly prefer low P/E ratios. You can find value stocks using the Dogs of the Joe investing strategy by purchasing the 10 highest dividend-yielding stocks on the Dow Jones at the beginning of each year and adjusting the portfolio every year thereafter. Value stocks might be an attractive option in 2022 because they tend to do well when interest rates are rising, and also Federal Reserve has indicated that it could raise rates this year. In value investing, an investor waits for the proper time to make a profit on their investment. However, with value investing, the wait might often be longer than intended. They have a solid track record of paying dividends and are quite steady in terms of market volatility. As a result, investors favor them as a hedge during market downturns. Number 9. Growth stocks. Growth stocks are best suited to investors with a long-term time horizon. Generally, a person nearing or in retirement would not fit the profile for an allocation that is heavily weighted in growth stocks due to both time and volatility. Growth stocks are companies that are growing their share prices, revenue, profits, or cash flow at faster rates than the market at large, hence the name. Investors choose growth stocks to earn profits from the rapid price appreciation they offer, rather than income from dividends. Investment in growth stocks can be risky because they typically do not offer dividends. The only opportunity an investor has to earn money on their investment is when they eventually sell their shares. If the company does not do well, investors take a loss on the stock when it's time to sell. Growth stocks differ from value stocks. Investors expect growth stocks to earn substantial capital gains as a result of strong growth in the underlying company. Number 8. Dividend stocks. Dividend-paying stocks provide a way for investors to get paid during rocky market periods. When capital gains are hard to achieve, they provide a nice hedge against inflation, especially when they grow over time. They are also tax-advantaged, unlike the other forms of income, such as interest on fixed income investments. While investing in dividend-paying companies is not guaranteed to be profitable, dividend stocks offer at least a partial return on investment that is virtually guaranteed. It is very rare for dividend-paying companies to ever stop paying dividends. In fact, most of these companies increase the amount of their dividends over time. The number one consideration in buying a dividend stock is the safety of its dividend. Dividend yields over 4% should be carefully scrutinized. Those over 10% tread firmly into risky territory. Among other things, a too high dividend yield can indicate the payout is unsustainable, or that investors are selling the stock, driving down its share price and increasing the dividend yield as a result. Number 7. Mutual funds. A mutual fund is a type of financial vehicle made up of a pool of money collected from many investors to invest in securities like stocks, bonds, money market instruments, and other assets. These are operated by professional money managers who allocate the fund's assets and attempt to produce capital gains or income for the fund's investors. A mutual fund's portfolio is structured and maintained to match the investment objectives stated in its prospectus. The value of the mutual fund company depends on the performance of the securities it decides to buy. So when you buy a unit or share of a mutual fund, you are buying the performance of its portfolio, or more precisely, a part of the portfolio's value. Investing in a share of a mutual fund is different from investing in shares of stock. Unlike stocks, mutual fund shares do not give their holders any voting rights. A share of a mutual fund represents investments in many different stocks or other securities instead of just one holding. Number 6. Robo-advisor portfolio. Robo-advisors are increasingly popular among younger investors. Today, it's clear as day that robo-advisors are gaining serious traction in Singapore. According to German market research firm Statista, these automated investing platforms are projected to have assets under management (AUM) worth over $4 billion by 2025. Robo-advisors, also known as automated investing services, use computer algorithms and advanced software to build and manage your investment portfolio. Services range from automatic rebalancing to tax optimization and require little to no human interaction, but many providers have human advisors available for questions. Traditional portfolio management services often require high balances. Robo-advisors, on the other hand, typically have low or no minimum requirements. Because of that and their low costs, robo-advisors let you get started investing quickly, in many cases within a matter of minutes. If you're new to investing and do not know how to go about it, robo-advisors are the perfect way to begin. You start by taking a questionnaire that indicates your investment goals, your time horizon, and your risk tolerance. Based on that information, the robo-advisor creates your portfolio. You don't need to select investments or maintain them through periodic rebalancing and dividend reinvesting. The robo-advisor handles all of that for you. Your only job is to fund the account and let the platform do the rest. Number 5. Exchange-traded funds. An exchange-traded fund is a type of pooled investment security that operates much like a mutual fund. Typically, ETFs will track a particular index, sector, commodity, or other asset. But unlike mutual funds, ETFs can be purchased or sold on a stock exchange the same way that a regular stock can. ETFs take the guesswork out of stock investing. They allow investors to match the market's performance over time, which has historically been quite strong. ETFs have several advantages over traditional open-end funds. The 4 most prominent advantages are trading flexibility, portfolio diversification and risk management, lower costs, and tax benefits. There are drawbacks, however, which includes trading costs and learning complexities of the product. Since ETFs own a diverse assortment of stocks, they don't have quite as much return potential as buying individual stocks. Number 4. High-yield savings accounts. A high-yield savings account is a type of savings account that typically pays 20 to 25 times the national average of a standard saving account. Traditionally, people have held a savings account at the same bank where they hold their checking account, making transfers between the two easy and quick. But with the advent of internet-only banks, as well as traditional banks that have opened their doors to customers across the country using online account opening, the competition on savings rates has skyrocketed, creating a new category of high-yield savings accounts. In opening a high-yield account, although the interest rates now hover around 1%, this yield still outpaces the 0.06% return you'd earn keeping your money in a traditional bank savings account. Because these savings accounts compound interest daily, you're earning interest each day, and you don't have to start with much to save over time. For example, by making a $20 weekly deposit, you can save $1,000 in 1 year, which equates to saving less than 3% per day. Number 3. Cryptocurrencies. Cryptocurrency trading has taken the financial world by storm and has seen remarkable growth. Spurred by the incredible growth of Bitcoin and Ether, the field of cryptocurrencies has only continued to expand. cryptocurrencies have been around since 2009. Bitcoin and most other cryptocurrencies are supported by a technology known as blockchain, which maintains a tamper-resistant record of transactions and keeps track of who owns what. Public blockchains are usually decentralized, which means they operate without a central authority such as a bank or government. One common way cryptocurrencies are created is through a process known as mining, which is used by Bitcoin. Mining can be an energy-intensive process in which computers solve complex puzzles in order to verify the authenticity of transactions on the network. As a reward, the owners of these computers can receive newly created cryptocurrency. Users can also buy the currencies from brokers, then store and spend them using cryptographic wallets. Because they cannot be printed or seized, cryptocurrencies may also provide a safe store of value. There are many ways to buy cryptocurrency, though the most accessible method for beginners is likely to be a centralized exchange. Centralized exchanges act as a third party overseeing transactions to give customers confidence that they are getting what they pay for. Number 2. Corporate bonds. Some companies turn to the corporate bond market to borrow money when they want to expand operations or fund new business ventures. A company determines how much it would like to borrow and then issues a bond offering in that amount. Investors that buy a bond are effectively lending money to the company, according to the terms established in the bond offering or prospectus. Unlike equities, ownership of corporate bonds does not signify an ownership interest in the company that has issued the bond. Instead, the company pays the investor a rate of interest over a period of time and repays the principal at the maturity date established at the time of the bond's issue. And last but not the least, number 1. Real estate. Real estate is considered one of the best investments nowadays, having numerous benefits. With well-chosen assets, investors can enjoy predictable cash flow, excellent returns, tax advantages, and diversification. And it's possible to leverage real estate to build wealth. If you invest in rental properties, you become a landlord, so you need to consider if you will be comfortable in that role. As the landlord, you'll be responsible for things like paying the mortgage, property taxes and insurance, maintaining the property, finding tenants, and dealing with any problems. The benefits of investing in real estate include passive income, stable cash flow, tax advantages, diversification, and leverage. Real estate investors make money through rental income, appreciation, and profits generated by business activities that depend on that property. Real estate is a great way to diversify your investment portfolio. You can offset the risk of high-risk investments such as money invested in the stock market. It can be a liquid asset if you need it to be. Don't invest money you need immediately, but know that any money you have invested in properties can usually liquidate within a few months if required. Alright, that's it for today. We hope you learned a lot from today's video. Tell me, what other things do you think you should invest your money on that didn't make it in today's cut? Comment down your answers below. Please don't forget to like, share, and subscribe to our channel, Fortune Figures, to get exclusive videos from us. Thank you so much, and we will see you again next time.